Good morning. Thank you for joining us for today's webinar. For those of you who just hopped on, this is our 2014 tax update for tax-exempt organizations. If you're attending this webinar to receive California CE credit, please note that if you meet the requirements, which I'll go over in a moment, that you'll receive an email within 3 business days to access your certificate of completion. So let me just jump into a few housekeeping items. You'll see on your webinar pane that you can maximize or minimize the pane during the presentation by using the red arrow buttons circled on the slide. We also encourage you to ask questions during the webinar, which you'll see a little box to enter questions. Just type your questions in and hit submit, and we'll answer them either during the presentation as time permits or at the end. To modify your audio settings, if you're calling in from a telephone, please click on the Use Telephone Audio mode, or if you're listening through your computer, then please click on the Use Mic and Speakers option. So quickly, for those of you who want California CE credit, you have to meet the following criteria. You must be using a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of this webinar. You must actively respond to at least 75% of the polling questions. There will be 5. And you must complete the evaluation survey at the end of the webinar. So quickly, I'll give you an introduction to our presenter today. Her name is Lynn Henley. She is a tax partner and head of Armanino's nonprofit tax practice. Lynn has been providing consulting and compliance services for more than 18 years to a variety of tax-exempt organizations, including public charities, private foundations, supporting organizations, social welfare organizations, labor unions, social clubs, and business leagues. She holds a master's degree in taxation from the San Francisco State University and an undergraduate degree from the University of California at Berkeley. She belongs to the American Institute of CPAs and the California Society of CPAs, and she's also a current, or has been an adjunct professor with Golden Gate University. And with that, Lynn, hold on. Let me quickly go over the learning objectives for today. So during today's webinar, we're going to identify key developments in the last year affecting tax-exempt organizations. We're going to discuss the appropriate codes in the grants section of Form 990-PF. We're going to apply the latest rulings in their exempt practice. And we're also going to review how to accurately complete Schedule R to reflect the organization's transactions with its controlled subsidiaries. And with that, I will turn it over to Lynn for a presentation overview.
Thank you, Debbie, and thank you all for being here this morning. So let's get right to it. In this presentation overview, you'll see there's quite a few topics there. As this is a tax update, we're not going to look in depth at any of these topics, but we are going to mention what is significant about them, and then, just if this is relevant to you, go ahead and check these things out. So I think we'll move right along and hopefully give you the heads up where you need it. First, we're going to talk about Form 990-PF significant changes and clarifications. Then Form 1023-EZ, IRS has issued a draft there. We're very excited about that. Then we'll look at some recent rulings from the IRS. Then talk about Form 1024 a little bit. We want to know, should we file, should we not file? What's the thinking on that? Also some things to be aware of regarding social media co-ventures, the new reinstatement guidance, the final and temporary regs regarding Type 3 supporting organizations. We're all very excited about that, to have some guidance. Then income from controlled subsidiaries and some advocacy by 501c3 organizations. And if time permits, we'll talk a little bit about the holding and Citizens United and why that's important. So in each year, the IRS issues form instructions, and near the beginning of the form instructions, they'll have a what's new section. It's always a good idea to look at that what's new section. It can also be fairly entertaining. And I've picked out a few to share with you today, but to get all the details, just go ahead and take a look at that on the 990 instructions, and as we'll see in a moment, on the 990-PF instructions as well. So generally, Form 990 does not allow attachments, but there are exceptions with regard to organizations that have terminated. So if your organization has terminated, check the form instruction for required attachments. There's also a clarification on when an organization can use the, quote, special rule, unquote, quote, for which contributors may be excluded from Schedule B. So if you are a 509A1 organization, and remember 509A1 is a subset of 501c3. So if you're a 509A1 organization, the contributors that have to be included on your Schedule B are those that contribute the greater of 2% of your contributions for the year or $5,000. As a practical matter, what this means is that for large organizations that receive a voluminous number of contributions, it allows them to only have to disclose the larger contributors. Because if you think about a community foundation with thousands of donors, it doesn't make any sense to have all those people listed on the Schedule B. It's a lot of data, but not very much information. That's been the rule for a long time, but I think the IRS has struggled with it and organizations have struggled with it, so they were thinking that it's a good time to, clarify that and bring it to people's attention. Another area where we've had a number of conversations because it hasn't been clear is the reporting of director's compensation for non-director independent contractor services. So what that is, let's say that you have a theater and one of your board members is an actor, and you pay that board member for his acting through a 1099. So one school of thought prior to this clarification was that that independent contractor service income should either be reported in Section B of Part 7 if it met the threshold, or on Schedule L, again, if it met the threshold. What the service has now clarified is that it doesn't matter what kind of services your director is being paid for, that compensation needs to be reported in Part 7, Section A. So that's going to be helpful. I think it will save us all a lot of time, and we'll also be then comparing apples and apples from organization to organization. Also some clarification on how to report compensation from a management company. Generally that's not going to be in Part 7, Section A, but if you're dealing with that kind of compensation, be sure to check the instructions. 990PF changes, again, check out the What's New section. One thing the IRS has done which will be very helpful to the sector is they've added an item G to the return heading. It's a box that reads Return of Former Public Charity. What this is for is that if a public charity fails the public support test 2 years in a row, the return for that second year is supposed to be a 990PF rather than a 990. What has happened in the past is that those organizations who have volunteered to comply and file the 990PF after they had filed the 990 in the years before were running into problems because the service, the IRS, was expecting a 990. And when they received the 990PF, they either kicked it back because it said, oh, you're not a private foundation, or they didn't acknowledge the receipt of a return at all, and so they'd issue the notice that says we didn't get your return, here's your $50,000 penalty. So now this item G hopefully will allow the service to flag those returns and say, okay, we're not going to get a 990 for this year, but we have received the 990PF. So that's a good news. There's some clarification on the reporting of program-related investments, so if you're dealing with those, be sure and check out those instructions. And a significant change that is causing a lot of labor out there, a lot of development officer challenges, is that there are now new codes to be used in Part 15, Line 3 of the 990PF. That section is where the foundation reports its grantee information. So you have the name, the address, the quote-unquote foundation status, what the purpose of the grant was, all that information, that's where that is. So in the foundation status column, if you looked at Forms 990PF, you would see a variety of responses there. Everyone genuinely trying to comply and doing the best they could with the instructions, but not a lot of conformity with regard to that reporting. So now we have new codes so that every private foundation will be reporting in the exact same way. The reason this is labor intensive is that there are a number of new codes, and we'll just briefly later in the presentation actually look at the number of the codes to be used. I mean, a foundation was supposed to be gathering this information all the time, but now we're sort of forced to step up the compliance a little bit. So be sure and let your development folks know about that if they don't already. Okay, Form 1023-EZ. The IRS has issued a draft 1023-EZ for use by small organizations. It is a 3-page application rather than a 25-page application. Now that looks like a tremendous difference. In reality, many of those 25 pages of the regular 1023 were specific to the type of organization applying, so you didn't actually have to fill out 23 pages, but now it's just 3 pages. There are still attachments. It's still a challenging task, but certainly not what it was for the small organization. So you can see there the draft instructions are going to limit the use of that form to organizations with gross receipts equal to or less than 200,000, total assets equal to or less than 500,000. And the organization must qualify as a private foundation or a publicly supported charity, described in 509A1 and the corresponding 170 sections, or 509A2. So notice that 509A3, which is the supporting organization code section, is not there. Which brings us to polling question number 1.
Thank you, Lynn. So this is our first polling question out of 5. So please answer them if you are trying to receive CE. So our first question is, if an organization fails the public support test in 2013 and 2014, for what year will it file its first Form 990-PF? Is it A, 2013, B, 2014, C, 2015? And for those of you who are wondering if you'll have a copy of these slides after the presentation, I know Lynn's been giving you some great information. You will receive a copy of the slides in an email within a day or two of the presentation. So we'll plan on closing the polls here in a couple of seconds. Put in your answers in 3, 2, and 1. And I'll turn it back over to Lynn.
Thanks, Debbie. So thank you for responding to this polling question. So the tricky thing here is that when you file in 2013, or when you fail your public support test in 2013 and fail in 2014, it isn't the next return where you have to file the PF. It's actually, that's the return for that second year. So the answer is 2014. Okay, now we're going to look at some of the recent private letter rulings that have come out. There were a number of rulings that have come out since we last met. I chose these because they were either significant in that the service is offering a consistent view, or because it's something that we need to remind ourselves of. So something that we're seeing in our practice that's coming up a lot. So let's start with the first PLR, the 2014-15007. In this ruling, there was a denial of request for recognition of exemption because the service said that this organization it has a significant social welfare activity in addition to its charitable activities. And the service relied on a Supreme Court case, which was Better Business Bureau of Washington v. U.S. In that case, the Supreme Court held that the presence of a single non-exempt purpose, if substantial in nature, would destroy the exemption regardless of the number or importance of truly exempt purposes. And the court found that a trade association, in that case, they had an underlying commercial motive that distinguished its educational program from a program carried out by a university. So what we have in the Better Business Bureau holding is that the court sort of had a narrow holding that even if you're out there doing charitable work, if your non-charitable work is significant, you cannot be exempt. So, and over the years, because Better Business Bureau came out quite a few years ago, if you look at the cases that have come out since then and a lot of the PLRs, you will see that time and time again they go back to this holding. Now, the good news is that within the sector, there is a move afoot to get away from this approach. So there's something called the commerciality doctrine, which evolved through case law, but it's not in the code. And the folks at the AICPA and independent sector and similar folks that work within the charity are like, okay, that's not in the code. What we would like to get to is something called the commensurate in scope test, meaning that if you are doing a huge, huge amount of charitable work, and in addition, you also have significant non-exempt activity, that you shouldn't automatically be denied exempt status. So we're trying to get to a more reasonable place, but so far Better Business Bureau is holding, and the service said, you know, you guys, because you do so much and that looks more like a social welfare organization, you will not be granted status under 501c3. In the next ruling, this is here because just to show the IRS is being consistent with this particular view of who can be exempt and who can't. This is an organization that was providing services. They were providing services to 501c3 organizations. And in their mind, because they were going to, you know, help charities do a better job at being charitable and be more efficient, they thought that that was exempt. What they didn't realize is that under 501c3, the actual activity has to have an exempt, it has to be an exempt purpose. So if you actually read 501c3, you'll see an enumerated number of characteristics, you know, charitable, educational, scientific, testing for public charity, things that are by their nature charitable. Providing services to other charitable organizations is not a charitable activity. So when this organization that was going to provide administrative and consulting services to the charity went to get exempt status, the IRS said, no, you're really operating in a commercial manner and we don't think you should be exempt. The next holding, 2014-6011, this is just a reminder that charities are not to become involved in politics. So this was an organization that did a lot of editorializing, and it was fairly blatant. They wanted to have their publications, website and paper, were constantly saying good or bad things about particular candidates, depending upon which side the candidate was on. And the IRS said, no, that is not educational, that's political. And so they were very clear about that and denied these folks exemption. And then in 2014-15006, we had another adverse determination. These folks were also not operated for exclusively exempt purposes. Again, not allowing for significant non-exempt activity. PLR 2014-19017. This is really good news. It's not anything new, but it's good that the service is confirming what, you know, we all understood from reading the code. A private foundation needs to, in order to maintain its exempt status, needs to distribute a certain amount of income for each year. And that calculation is based on the average fair market value of the non-charitable use assets that the organization holds. What this PLR tells us is that a charitable use asset is not going to be included in that return calculation. So it was about these folks, this private foundation owned some land, and the government had an operation down the road and they needed hay. So on this undeveloped land, the private foundation agreed to grow some hay, and then the government came in and harvested the hay and used it for feed. And the private foundation sold the hay to the government at a greatly reduced price. So it wasn't it had no profit motive. And when they went for the ruling on this land, they said, look, we're not getting a return on this undeveloped land. And in fact, we're doing, this charitable work because the government needs the hay. Can we exclude this from our minimum investment return calculation? And the answer came back, yes. So remember, when you're doing that minimum investment return calculation, that it's only based on the non-charitable use assets. PLR 2014-20020, this was a website church. This is relevant because there's so much activity on the web, and everyone is now thinking that, oh, let's have a website church or a website this or a website that. So I've included it here for that reason. The important thing to note about this PLR is that whether the church is on a website or it's at the beach or wherever it is, it still needs to have certain characteristics in order to meet the definition of church under the IRS. Now, there was a court case called American Guidance Foundation v. Commissioner. And in American Guidance Foundation, the court identified 14 characteristics that are common among churches. Now, in order to be exempt as a church, you don't have to have all 14 of those characteristics, but you have to have enough of them that you look like a church. So this website, quote-unquote church, had a few of the characteristics, but one of the things that it absolutely did not have, and what the service pointed out, was that it did not have a regular congregation. So you think to yourself, well, wait a minute, my congregation just happens to be on the other side of the computer screen. And so the next part then to understand is that when the service thinks of regular congregation, the association principle is going to drive whether they think you have a congregation or not, meaning that to be a church, the service views it as critical that people get together in the same place at the same time in order to form a group that qualifies as a congregation. So just bear this in mind if you're thinking about opening a website church, that this ruling is out there. And lastly, in the last PLR there, we have another organization providing services that are to organizations, and it's just that is providing services is not an exempt purpose. This is critical, again, because of the internet. You, I'm sure, have seen many sites on the internet that are saying, oh, we're going to facilitate the donations to this charity, or we're going to do this over the web or that over the web. And it's like that activity is still commercial in nature. Just the fact that those services are being provided to charities does not make the activity charitable. So if you're thinking about, having a website and applying for exemption, this is a good ruling to read to understand, oh, I guess what I am proposing on doing is actually not by its nature a charitable activity. Okay, so the 1024, we're just going to briefly look at this. So if you want to apply for exemption as a 501c3 organization, a public charity or a private foundation, where people can give you money and they take a deduction for it, you have to file a Form 1023. If you want to be exempt under some code section other than 501c3, you don't actually have to apply for recognition from the IRS or from California. You can just organize and go on about your merry way. So why would someone file a 1024 requesting recognition from the IRS if they don't have to? Well, the advantage, one of the advantages of filing the 1024 is that you have limited assurance that your exemption cannot be retroactively revoked. So if you have initially been granted recognition of exemption and you're going on about your merry way, and then at some point something happens and your exemption is revoked, it's not retroactive. So that can be handy. Also, donors, rightly or wrongly, there's a halo effect among donors, meaning that if you can show them that you have a determination letter from the Internal Revenue Service, they may be more willing to grant funds to your organization. Now, many times a C4 will be operated in connection with a C3, so I think that gives, if you file and get that determination letter from the IRS, it gives your C3 a little more comfort with regard to sharing staff, facilities, etc. with the C4. And then we have the newly instituted 27-month requirement, and actually month and requirement are still two words, sorry about that, for retroactivity. Polling question number 2.
Thank you, Lynn. So our second polling question, it's going to be a true or false answer. So the question is, an organization that wants to be exempt under Section 501c4 must apply for recognition of an exemption by filing Form 1024. So is that statement true, A, false, B, or not sure, C? And as a reminder, the slides will be available on our website, and we'll also be sending them to you via email after we're through. So I'll give you all a few seconds to respond, and we'll close the polls in 3, 2, and 1. And I'll turn it back over to Lynn.
Great, Debbie. Okay, so we did pretty good on that one. So if you want to be exempt under any other section besides 501c3 at this time, you do not actually have to file the 1024 for recognition from the Internal Revenue Service. I know it sounds odd. You would think that you would have to file, but not at this time. Okay, something a little more fun here, social media co-ventures. So because, again, of the web and Facebook and Twitter and Yammer and all kind of good stuff out there, a lot of organizations are partnering in various ways with some of these social media sites and providers. A couple things to watch out for on that. When you have a link to anywhere, whether it's social media or any kind of a site, a for-profit corporation, another nonprofit, you need to monitor the content of their web pages when you link to those web pages. The reason being is that a link can cause your organization to inadvertently become involved in political activity or cause it to have unrelated business income. And bear in mind that the content on a web page can change, and there's no obligation for the person running that web page to let you know that the content has changed. So one of the things you need to do if you're going to have a link is to monitor what's on the other side of that link. So let's talk about inadvertent political activity. So let's say you have a link, and on day one when you establish the link, It says, oh, our community has green trees and tall grass, and everybody's happy here. And you think, okay, that sounds pretty innocuous. It's just a nice statement about the community. And then somewhere down the road, they add something to their website that says, yes, we have tall trees and green grass and everybody's happy. And it's all because X is our congressperson. And by the way, he or she is running for re-election. So all of a sudden, if you have a link to that particular page, there's a very good chance that now you involved yourself in political activity. So that's a pretty basic example, but just a way of explaining how that can happen. Also, the link to websites that could result in unrelated business income to your organization. So if you have a link, let's use GE, for example. We'll bring good things to light, is their tagline. If you connect to their website and it just says GE, proud sponsor of X organization, that's great. That's not going to hurt anything. And what folks do after that is sort of their own business around the GE website. If, however, when they click on the link, that web page that they're taken to says, oh, buy our washing machines, they're the best ever. We're located at 123 Main Street. So all of a sudden we have an inducement to buy, we have a qualitative statement, and we have that contact address activity. So we have all kinds of things that create unrelated business income. So that's just an example of how a link can result in UBI. So be sure to monitor those links. Now we're all very excited because we have reinstatement guidance from RevProc 2014-11. So if you're an organization that failed to file for enough years that the service said, well, sorry, you're not exempt anymore, now we have some guidance about getting retroactive reinstatement. So in RevProc 2014-11, there are 3 processes, and each process applies to a different set of circumstances. So in Section 4 of that RevProc, you'll see the instructions for retroactive reinstatement for small organizations within 15 months of revocation. And for these folks, we talked about the 1023-EZ earlier. As soon as that's available, those folks that fit in that category, the small organization category within 15 months of revocation, they're going to be able to use that 1023-EZ. So that's going to become getting reinstated a lot easier. The second process described in that RevProc is the retroactive reinstatement of organizations within 15 months of revocation that do not qualify as small organizations. So in other words, they can't use the first process because they're too big, but they are still within 15 months of revocation. And then finally, the process for those folks that have been revoked more than 15 months ago and are now just getting around to addressing the issue. So great guidance there, and we welcome it because everybody was dealing with this a little bit differently. Okay, requirements for Type 3 supporting orgs, notice 2014-4. This was actually, the 2014-4 was specifically about supporting orgs of government entities. Very helpful because that's always been an area that's been a little bit murky. Haven't really understood that, but now we have very specific guidance in 2014-4. More generally, we now have final regs regarding Type 3 functionally integrated or non-functionally integrated supporting organizations. So Type 3 organizations have been problematic for, I think, practitioners and folks that are Type 3s, in that it's a complicated area. So just to back up a little bit, a supporting organization derives its public charityness by the fact that it is hooked on to a public charity that satisfies the public support test on its own. Or it can be attached to a government entity, which is by its nature publicly supported. Supporting organizations are divided into three types: type 1, type 2, type 3. So type 1 and type 2 we have down pretty good because those are they're easy to identify and they have a close connection with the organization being supported. What has been more difficult historically is the treatment of type 3 organizations. And you can see there on the slide that type 3s are divided into a couple of subcategories. The first category being functionally integrated, and then the second category non-functionally integrated. So a type 3 organization has a distant relationship to its supported organization. So the supported organization is not controlling the type 3. So let's say an example of functionally integrated would be, let's say we have an organization, public charity, that does not have its own fundraising department. So along comes a supporting organization, and it is going to provide the fundraising activities for this organization. And of course, all of the money from the fundraising goes to the supported organization. So the way the regs look at this is that that type 3 is going to be functionally integrated because, and here's the phrase, if it were not for the type 3 functioning that activity or engaging in that activity, the supported organization would have to do it itself. Okay, so this is, or if you're, let's say you're a publisher and your type 3 organization does your printing or they handle your internet publishing, that's integrated with what you do. So that's functionally integrated. A non-functionally integrated type 3 has even a more distant relationship. It's not functionally integrated to the supported organization. It just exists to support it. Folks are and were concerned that such a long distance relationship between the supported organization and the supporting organization sort of meant that the type 3 non-functionally integrated organization was out there on its own doing what it wanted to do, and there was very little control or requirements. So in exchange for this long distance relationship now, that type 3 non-functionally integrated supporting org has both a payout requirement and an attentiveness requirement. So the payout requirement is fairly straightforward. I believe they landed on 3.5% of the net assets, sort of a foundation, private foundation calculation, but it's at 3.5. The attentiveness requirement, it goes on for about 3 pages, but it basically means that the contribution from that supporting org has to be significant enough to the supported org that it matters. Okay? In other words, if I have a supported org with a budget of $10 million and the type 3 gives them $5, that's probably not enough to create, to match that attentiveness requirement. Okay, controlled subsidiaries. This is in this tax update because we have a number of clients that battle with this, and I know that there are folks out there talking to other practitioners that a lot of folks are sort of unaware that these rules exist. So I wanted to just touch on these. So in general, an organization's portfolio income, that means interest, dividends, capital gain, rental real estate, except if it's debt financed, is excluded from treatment as unrealized business income. Okay, so that's the general rule. If, however, any of those items are received from a controlled organization, then there's a big chance that you're going to have that the controlling organization may have to recognize UBI upon receipt of that income. In order to have the relationship that's going to cause the UBI under Section 512, there has to be the element of control. So, and control in general, there's a lot of details, but just think more than 50%. So whether it's stock holding or whether it's a partnership interest, just think more than 50%. And what that'll do for you is it will cause you to dig deeper into the detail and into what your situation is. I think so. Again, this is more of a heads up. Also, in this situation, make sure that you are capturing your net operating losses, because we want to have those out there for us when we need them. So I think that, so it's a complicated area, but just know that if you have a controlled situation and your controlled subsidiary, excuse me,
so give Lynn have a second here. She's going to grab a drink of water.
So,
and as a reminder, we're also going to have the slides available for you. So I know, again, there's a lot of information here, but it'll be available for you. So no worries.
So thank you for that. Excuse me. So the best thing to do is to realize, okay, if I have a controlled subsidiary, whether it is a tax-exempt subsidiary or a taxable subsidiary, because these rules apply to both, I need to say, okay, do I have control, and am I receiving any of these types of income from my controlled subsidiary? Now notice something that is absent from that list. Dividends are not listed there. And why would that be? That would be because dividends are not deductible by the corporation when they're paid. Conversely, interest, annuities, royalties, rental payments do create a tax deduction. So let's say we have a for-profit subsidiary. And whatever that for-profit subsidiary is doing, it's unrelated to the exempt purpose of the parent. Okay? Let's say it's a macaroni manufacturer. Okay, and the subsidiary is using the parent's name, and it's going to pay them a royalty for the use of that name. And let's say it's $100,000. So when the for-profit subsidiary does its tax return, it's going to take a deduction for that $100,000 of royalties being paid to the parent. And so it will have to pay less tax. Now, without Section 512, when the royalties hit the parent's tax return, they would be exempt. They wouldn't have to pay tax on it. And so what you've done then is you've shifted income from a taxable entity to a tax-exempt entity when they were really one organization. So yes, they have technical separation because they're different entities with different tax IDs, but really the operation is a single operation, and there's sort of a fake deduction at the for-profit level. So what the IRS said with 512B, and it's really 512B13, is they said, look, if you're getting the kinds of payments from your subsidiary that have given the subsidiary a deduction and reduced what would be UBI if you did it yourself, then you're going to have to pay tax on that. So one of the things that is very helpful when thinking about what should be taxed and what shouldn't be taxed is just to say, look, if this were all rolled up into one big organization, what would it look like? And I think then you'll have your answer. Quick look at advocacy by 501c3 organizations. Remember that 501c3 organizations are absolutely allowed to engage in lobbying, okay, or advocacy. And in fact, some people would argue that it is part of their responsibility to perform advocacy when it's appropriate. Also bear in mind that advocacy can be no substantial part of what the organization does. Now, when you say, okay, Lynn, that's great, but what does no substantial part mean? Well, the service has not given us a bright line on that. So I can't tell you that it's 3% or 5% or 20%. And that leaves our organizations, as their advocacy activities crank up, it leaves them in sort of an uncomfortable state, because they're like, well, how much is too much? I don't know. No one will tell me. If it's 3%, I'm probably okay, but what if it's 15 or 20% of my activity? Then is that substantial? So for those organizations that want to engage in a level of activity that might be considered substantial, there is an election to be made under Section 501H where you can do a math test, basically. And it's very objective, and it measures your exempt activity versus your advocacy activity. And if you fall within certain limits, then you have the assurance that you have not violated the limits on your legislative activity. When you're measuring your legislative activity, remember that there are exceptions. Some of them are listed here. So a nonpartisan study or analysis and research, that's not lobbying. If you're examining broad social, economic, or similar problems, that's not lobbying. And if Congress makes a request to you for technical advice or assistance, buy a plane ticket and go ahead and testify. If that's all they've asked you for. So that's not going to count as lobbying. One of the things that is problematic about the limits under the 501H election is that the numbers that they're using to do the math test are the same numbers that they used when the election became available. So these figures are lower than they need to be because they're not matching, inflation and the fact that, things are more expensive than they used to be. So we have one problem there with that, doing the math test, and the second being that if you have a very, very large organization, there is an overall $1 million limit, regardless of what the size of your organization is. There's actually a dollar limit, and so for very, very large organizations, something that is 2 or 3% of their activity, right, which would more than likely qualify as no substantial part, is going to be well over $1 million. So those folks aren't going to make that election. So one of the things that is out there currently is that it's a push to the IRS to give us some new numbers. Which brings us to polling question number 3.
Thank you, Lynn. All right, so our third polling question is another true-false answer. So true or false, public charities may not engage in any amount of advocacy. A, true, B, false, or C, you're not sure. And for those of you that are submitting questions to us, it seems like all of them are around the social media website issue. We will hopefully be able to get to those at the end of the webinar. So we haven't forgotten you. We're just going to run through everything else and then see if we've got some time. So we'll close the poll here, put in your answers in 3, 2, and 1. And I'll turn it back over to Lynn.
Oh, now this is terrific. So 93% of you said that's false. So 501c3 organizations may engage in advocacy as long as the level of activity does not constitute a substantial part of their overall activity. So well done. The next thing I wanted to touch on, because it's been in the news and there's a lot of sort of, well, inaccurate information out there. Just wanted to give you a little rundown about why the holding in Citizens United is important. And you have the site there for you if you want to actually read the case. It's kind of interesting. But a tiny bit of background. Way back when, there was a case, Santa Clara County versus Southern Pacific Railroad. And in that case, the court held that the 14th Amendment applies to corporations. So you'll hear people bandying about the phrase, oh, corporations are people. That's what they're referring to. So it's not exactly corporations are people, but it's the amendments apply to corporations. So in the late 1800s, there was quite a bit of corruption with regard to big money funding federal campaigns. So in 1907, we have the Tillman Act, and that banned corporations from funding federal campaigns. We wanted our elections to be, quote unquote, pure, unquote. Then in 1947, the Taft-Hartley Act expanded that ban to labor unions, because you can imagine that once the corps were no longer able to fund federal elections, they didn't want the unions to do it either. So, which brings us to 2002. So there was a BCRA, which was an act from 2002. It prohibited corporations and unions from using Treasury funds for electioneering communications. Okay, what that means is that a corporation's Treasury funds, it's just the money they have on hand, right? It's not U.S. Treasury, it's their own money they have on hand. And electioneering communications, primarily it was mostly about television and radio. So there would be big radio spots and television commercials that corporations were paying for out of their Treasury funds to support this candidate or that candidate. And so in 2002, the BCRA prohibited that. So along comes a movie. It was Fahrenheit 9/11. And this was a movie that really didn't show President Bush in a very good light. So the folks on the right took Fahrenheit 9/11 to court and said, look, you shouldn't be able to show this movie because this is political intervention. The court said, no, it's not political intervention, it's entertainment. It's a bona fide commercial enterprise. So you're just making a movie. So Citizens United then said, all right, if all it takes is that we're in the movie business, we're going to make a movie. And we're going to make Hillary the movie. And that didn't paint Hillary Clinton in a very good light. So they're like, okay, turnabout is fair play. And of course, the left didn't want Hillary the movie to be aired. So they took Citizens United to court under the Federal Election Commission. And before that commission, it ruled, it said, no, Hillary, the movie, you can't show that. That is political intervention. So they're like, well, the other side got to show Fahrenheit 9/11, and that was a bona fide commercial purpose, but Hillary, the movie, is somehow political intervention. So Citizens United said, you know what? That FEC, I don't think that was a consistent holding, so I'm taking you to court. So it ends up in U.S. District Court. And that court ruled that Hillary the movie violated the BCRA and it could not be shown. And Citizens United still wasn't happy, so they appealed to the Supreme Court. Now, when this case got to the Supreme Court, they were asked on whether Citizens United could show the film. That was the question. But because the court wanted sort of a united front, and because they went on recess, and we don't actually know what happened while the court was on recess, when the court came back from recess, the question they were answering was actually much broader than the original question they were asked. So when the Supreme Court finally made its ruling, there was a 5-4 decision, and the ruling was that the act from 2002, the BCRA, actually violated the First Amendment. Huge holding. The floodgates opened, and the super PACs were created. Because now corporations could give money, unlimited money, labor unions as well, to super PACs. And then these super PACs could go on and produce radio spots, television spots, whatever else they could think to wield their influence with, and it's unlimited. So, and we know there are corporations and unions have very deep pockets. And the problem with that is that the super PACs have to disclose their contributors. So we know who's giving money to the super PACs. Internal Revenue Code Section 501c4 organizations, on the other hand, do not have to disclose their contributors. And 501c4 organizations can engage in unlimited political activity as long as political activity does not constitute their primary purpose. So what we've created here and what we've ended up with are organizations that can receive unlimited funds from corporations and unions, and they do not have to disclose their contributors. So that is how Citizens United is impacting our elections.
Thanks, Lynn. And now we're going to go to polling question number 4. So our question is, what is the limit on the amount of political activity in which an SEC 501c4 organization may engage? Is it A, 2 times the amount of contributions the organization receives? B, there's no limit as long as all candidates are treated equally? C, there's no limit if election activity isn't the primary activity? Or D, all of the above? All right, and we'll close the polls in 3, 2, and 1.
Well, we have evidently had a change in slide here because most of you got this right. There's no limit if election activity isn't the primary purpose. So it says all of above there on the slide, but it's not. It's C, and most of you got that right. So good job on that. So last part of the webinar here, just wanted to show you the line 3 codes from part 15 of the private foundation return. You could see those the first 5 on this slide. So if it's a non-charity grant, right, we have NC. That was pretty clever of them to do that. And remember, private foundation giving to a non-charity has to perform expenditure responsibility. Also, watch out for anything that might qualify as a taxable expenditure. So 2 things to watch out there for. And then if you're giving to another private non-operating foundation, PF, et cetera, private operating foundation, exempt operating foundation, and PC, that's where we're seeing certainly most of the grants, the codes that we have, that we're currently processing. Those are grants to public charities described in 509A1 or 509A2. And notice again that 509A3 is not listed there. So if you're giving to supporting orgs, the code is not PC. And let's go to the next slide. Here are the supporting organization codes. And I think this gives us a good indication that the IRS is a little bit concerned about foundation grants to supporting orgs. So you'll see all the different categories there, some involving a disqualified person, and then the ones that don't involve a disqualified person. And then down at the second from the bottom, the supporting org, non-functionally integrated type 3. So those are our new codes. So if you have any questions about those, feel free to give a call. We can help you out with that. Last question of the day.
Thanks, Lynn. All right, this is our final polling question, and again, you have to respond to 75% of the questions to receive CE credit. So this question, and I think it may have been cut off, maybe Lynn, you can help me out here, but which of the following is not one of the codes that may be used to complete, is it?
Oh, part 15, line 3, the grantee status codes on the private foundation return.
Perfect. Thank you, Lynn. All right, so is the answer A, NC for a non-charity, B, PEF for a private emergency foundation, C, POF for a private operating foundation, D, PC for a public charity, or E, SO3NFI for a non-functionally integrated type 3? And since we're running out of time, I'm going to close these polls pretty quickly, so please put in your answers. And we'll close in 3, 2, and 1.
Again, you guys did super. We got a lot of folks out there realizing that a private emergency foundation is not one of the current codes, but it might be a good idea for us to have those. So maybe I'll talk to the IRS about that.
All right. Well, thank you, Lynn. And all right, I'm going to give us a quick overview of what we've just discussed. So we've looked at Form 990 and 990 PF changes. We've looked at Form 1023EZ. We've looked at recent rulings in the IRS. To file or not to file Form 1024. We looked at social media co-ventures, which many of you asked about, which Lynn will get to after the webinar. We'll follow up with you. And then we've also looked at advocacy by Section 501c3 organizations, and then income from controlled subsidiaries. So with that, again, we don't have time for questions, but if you have any further questions, please feel free to reach out to Lynn. Her information is on the screen, or to email us, and we'll get back to you as soon as we can. So thank you for joining us, and please come again and join us for another nonprofit or other webinar that we'll be holding. Thanks again.